let's go to Kevin's portfolio. We're going to see this pie chart. And this is the core of the story, Kevin. This is you'll tell people the answer that most of your money is in equities. So let's start there. Tell people what you're doing in equities.
So first of all, I used to run a mandate that was 50-50 for years, that 50% fixed income, fixed 50% equities. And in the last 2 years, I've changed that dramatically because I think fixed income is extremely expensive and a place where money will be dead for a while as rates and inflation sort of maintain their story in the narrative. And so I've reduced my exposure to fixed income to 30%, equities to 70%. And of that 70, my largest holding of the equity portfolio, and obviously I'm using, talking our own book here. I'm a shareholder in O Shares, the manager of the indices, and I'm talking about in the ETFs. But OUSA, which is really designed for preservation of wealth, the whole idea of OUSA from years and years ago when it was created was to take a subset of the S&P 500, the highest quality balance sheets, the companies with the most established business models, the ones that had consistent growth in their free cash flow and had strong return on assets. And that's a subset of the S&P. There's many companies within the S&P that don't qualify anymore. Taking United Airlines, a great company, but started the pandemic with $7 billion in debt. It has over $23 billion in debt now. And you can't find a business traveler on an airplane yet. And so it's a miserable situation for them. You certainly don't want to own that stock. There's no reason to. There's much better opportunities elsewhere. So you want to avoid those disaster balance sheets, and that's what OUSA does, and that's a 40% weighting. Europe, there's 50 names in Switzerland, in the Eurozone, and in England that are virtually household names. In the US, Nestle, Roche, for example. A lot of people think those are North American companies. They're not. They're in Europe. Europe is a postal code that a lot of people have hated for a long time, and yet many of the companies have close to 50% of their sales in the US and have traded a lower PE. So I find it very attractive. OEUR is that index. Again, high quality balance sheets, that's 20%. We talked about OGIG, that's the internet giants. It's volatile, but it has incredible growth metrics within it, that's 20%. And then an area that I hadn't invested in for a long time, but I've been in recently, which I find interesting, is mid-cap, small-cap. The Russell 2000, I would never invest in. 2/3 of the companies in that index make no money and have virtually no return on assets. But within the Russell 2000, there's a few hundred names that are more in the large-cap $4 to $5 billion range, and they're encapsulated in OUSM, and they actually pay dividends. It's a very interesting product. So I have higher quality names with return on assets that have free cash flow. That's my portfolio, 20% in OUSM. So you can see that this is sort of I like to call it very boring, actually. It's protected against inflation because most of these companies have pricing power. They're profitable. They have free cash flow. They provide distributions that are paid out monthly. This is really boring, and I really like boring.
Well, I'm going to share with people a little bit of data in a couple of minutes here. Let's talk briefly about fixed income because that's even more boring and perhaps dangerous while being boring. And then we'll do a little dabble on the crypto side. So fixed income, why have you shifted from 50% fixed income down to wherever you are now?
Well, depending where you go in the continuum fixed income, let's take corporate credits, BBB and above, investment grade. It's all about quality and duration. And right now, I've never seen such terrible pricing. You're basically, if inflation is 7% and you're making 3% on a 5-year corporate bond, you're actually losing money. So it's very unattractive. Same with government debt. I don't care if the 10 years at 2%. When inflation is 5 to 7, same problem. The way to look at inflation on fixed income product and cash is it's a tax. You make 20 basis points on your savings account in a bank account and a corporate account, and there's inflation 6. You're actually being taxed at 5.8%. So where do you go? You have to find companies that actually have growth within inflationary times and a pricing power. Those are equities. I find nothing attractive about fixed income. It's wildly overvalued, a place where money will go to die for a few years. I think returns will be abysmal there. So I have no interest in enhancing my exposure to it.
So you own as little as you can. Yeah, it's basically the lowest yields in a long, long time and the tightest credit spreads, the lowest return for the risk you're taking, and the risks are obviously the ones you've been talking about.